Good afternoon, everyone. Today was a bit of a poetic day, especially using both our Volatility Box tools along with the Cumulative TICK Pro indicator, and that's really what I'm going to be talking about in this video. We'll focus on the four major indice markets, so that's the S&P, the Dow, the Nasdaq, and the Russell. And I'll just walk through the action really step by step of what took place today. So I think you'll find it useful. If you don't have these tools, you can just follow along, but if you do have these tools, hopefully this gives you a better idea of how to use them effectively. Now, starting off in the morning, we had our Cumulative Tick Pro indicator. At that 7 a.m. mark, all of our conditions that we coded in as part of that tutorial were triggered to be true, where we were expecting a likely trending down move, especially for the near-term future, right? So that came right around 7 a.m. Pacific, which was right here. And from this point, we had just a little bit of a pull back in the bullish direction. Now, if I load in the market pulse line here, which that's free, and we're going to slowly just layer on each tool. So once I load in the market pulse line, you'll see that that pullback was directly into our market pulse. Now that is really just a very easy alternative to moving averages. You're not sitting there trying to play the guessing game of which moving average are you looking at. So the market pulse is a very clean way in combination with the cumulative tick that we were looking for a likely trending down move. You got the pullback to our levels in which we have more confidence in terms of building a position. And from that point, from this pullback, if I measure all the way down in terms of the trending down move that we saw, the S&P then continued to fall 0.92%. And if I show you that same move in the Dow here, the Dow from that same 7 a.m. mark fell, I think this was a bit deeper in the Dow, right? We fell, I think, from 7 a.m. That's all I'm looking at. And we'll take the high, 1.45%. If we come into the Nasdaq here, the Nasdaq from, again, that same 7 a.m. mark, 7 a.m., down to the low that we saw, 1.52%. And then if I come into the Russell here, the Russell from that same 7 a.m. mark, which was somewhere right around here, fell close to, let's just say 1.69, 1.7% if you took the real high right here. Right, so the whole idea here is based off of the cumulative tick that we were seeing, and this really works more so on the S&P than anything else. That's where the tick gives you a concrete amount of data. That's where we spent a good amount of time in that pro indicator tutorial. That's where you saw the first move. Right, so this was the notion that you were expecting a trending down move. Now the question starts to become, well, where are we going to exhaust and at least start to reverse? So A, what are some good targets for this short right here? That's question number one. And question number two is, where are you then looking at least trying to buy the dip, so to speak, and look for a reversal opportunity? So that's where, based off of the morning note that we sent to all of our members, we were on our scalper volatility box. So now, once I load in the scalper volatility box models, let's focus in on the S&P first here. So coming in that 7 a.m. mark, this is that first hour test. We checked to see whether or not we breached either side's scalper volatility box entry lines. We had, and that was then our sign to start to observe and see, hey, do we get the same reversal move on the opposite direction? That's to say, in this case, since the S&P triggered our lower end of the volatility box lines, do we see that the buyers are coming in right here and able to push up price action, at least that bare minimum amount, or do we instead go outside of the clouds? Now, in the case of the S&P, we did see that the buyers came in, and this is what gave us the okay to continue to use these scalper volatility box models for the rest of the day, at least until proven otherwise. Now, we come into that next hour. If you remember, based off of the cumulative tick, if I load that back in here, cumulative tick, we'll click apply. Based off of our pro version, we had the likely trending down move with all of the Boolean conditions being met right at this mark right here. Then we had our pullback. This is the same chart, but this time with the edge signals indicator. And you can see exactly where we made a move to. This is the next hour, the 7 to 8 a.m. Pacific hours, volatility box sign lines. We will see we fell into the volatility box sign lines, and from that point, really started to bounce. Now, typically off of our setup, we're looking for a breach of our volatility box line, and then this edge signal confirmation right here, and then we want a retest of this cyan line to give us that same entry, especially if you are using the full size futures contract. Now, in the case of the S&P futures, which this is different compared to the Dow and I believe the Nasdaq as well, we'll take a look at all those. But compared to the S&P right here, we never got that pullback to the cyan line, but what you did get is this chop inside of this zone between the other side's target line, and our entry line. And this zone right here, I've talked about this in last week's video, is where for those of you looking to try and take a bit more of an aggressive position here, you can start to use things like the SPY options, right, instead of the full size contract, which allows you to deal with this extra risk here. With the SPY options, this extra risk of 0.16% isn't really anything that I think breaks the bank or really pushes the trade over the edge. However, 5 points on the S&P, 5 to 6 points, that's a good amount of dollars, right? If we're looking at that as a full size, that's another $250 worth of risk that you have to be willing to take for this more aggressive entry. That's where, again, using the micro futures can be another alternative, still a little bit pricier in terms of the smaller account sizes. But the SPY options there, I think, give you the manner in which you can participate where this additional premium that you might be paying really doesn't matter that much, especially because more times than not, you'll see that the options pricing is still adjusting a tad bit here. With this move up, it probably adjusts, but then with this move back down, you get an opportunity to re-enter at some favorable prices for the options, especially using the options expiring on the day of with the SPY. And so that's one alternative there. Now let's take a look to see what continues to happen the rest of the day. Of course, before actually we do that, if I zoom out here, off of this breach right here on our volatility box lines, you'll notice that that was pretty much the picture perfect low for the day, which the volatility box lines helped you to capture, and then play this really nice trending move up, right? So that's one option where using SPY options, you are able to at least play this move a bit longer. The first target, for those that are wondering, is our bare minimum risk move, which is if you take the cyan entry line, subtract it from the outer edge of the clouds, that's 10.61 points, so you can round that down to 10.5 points on the S&P. You'll notice in that first burst move up higher, we made close to 20 points, then we had a pullback back towards the cyan line, missed it just a little bit short. So for those of you that did use the full-size futures contract here on a more aggressive scale, you were still spared in terms of that second contract being moved to break even, right? If I zoom in here, you'll notice we came close, but we missed it really just by one tick, and that continued to allow you to try and play this to the next second target, which is the opposite side's gray target line. That's right here, and to give you an idea of what that second target looked like, that was basically risking 0 with a break-even stop to try and make 31.5 S&P points. So that was the first trade in the S&P futures. Now the second breach came when you had an opportunity to get short. That's where price action breached our volatility box lines. This time we did get the edge signal along with an opportunity to re-enter at the cyan line. So the full-size futures here, also a very valid opportunity to enter, right, in a way that your risk is still defined. And if you try and see what that risk looked like in the S&P futures, I was giving it right around 5 points of room. You were looking for 5 points in the opposite direction. You went to our second target as well, which was 16 points, before you really then fell down a little bit lower, and then had your next reversal where into the final hour of the market, this is really the final few minutes, you breached even our shorter side and then continued to rip up higher through it. And now with our current open right now, the 3 p.m. open, you'll see we're now coming right back and chopping inside of our scalper volatility box lines. So that's an in-detail view of the S&P futures today, really using the cumulative tick indicator, using the market pulse line for that pullback to play that likely trending down move, using the volatility box to give you a place of targets, and using that same volatility box to start to build a long position here in the S&P futures. Now, if you were deterred by the cumulative tick being so negative, especially triggering a likely trending down move, and you skipped this first entry, I think that's perfectly valid, and it's a very logical, at least deduction there. But the second short is where you still had an opportunity to then participate with our ticks being really negative at that point, the cumulative tick. And so the short here started to become a lot more, I think, attractive from a logical trade as opposed to this long right here, which you'll see was also a little bit choppier, right? We went up, we came down, we went up, we came down, and then we went up, as opposed to the short right here where you went really just straight down to T1 and T2 before that final push up in the last hour of the markets. And if I switch over, let's take a look at the Nasdaq here. So let's switch to the charts of the NQ. Using the same scalper volatility box models, you'll notice in that second hour, we didn't breach our volatility box cyan lines in the second hour here on the Nasdaq compared to the S&P, which on the Dow you should notice something different as well. I'll show you that in just a second. And if you then take a look at all the different places where we had a breach in the S&P, right? This was right here on the S&P. We didn't see that same breach on the Nasdaq. We had a short opportunity right here. We came close, but not quite enough on the Nasdaq. It was only into the final hour did we breach our volatility box cyan lines on the Nasdaq. So very very quickly there, you should be able to tell, I think, just using common sense, using visual clues, that the Nasdaq was the lesser volatile of the market when you compare it to the S&P and the Nasdaq. Now, using that as, I guess, the third missing puzzle piece here, which is the Dow, that should then help to fill in the gap that, hey, if the S&P breached, it wasn't as a result of the Nasdaq. That means that the Dow must have also been more volatile, where really, if you were trying to rank it here, the Dow would have been number one. So let's switch over to a chart of the Dow here. And the chart of the Dow should look a little bit different here, right? So in that same next hour here, where the S&P hit just our cyan line and bounced from there, the Dow instead fell a little bit deeper, this time deeper into our clouds. You got the edge signal here. You then had plenty of opportunities to enter at the cyan line or better. Chopped around sideways here inside of this zone where, for those of you looking to enter at the clouds, you even got that entry, which basically cuts your entire risk in half, where at this point, if you try and see what your actual risk is on the Dow, that's close to 40, 45 points with the extra room that we give it. And that 45 points starts to make for a very feasible trade for really all account sizes. And again, if your account size can't handle the 40 full-sized Dow futures contracts, that's where the micros still give you an alternative, right? The micros looked very similar as well. And if you can't use the micros as well, that's where DIA options give you a way to play this. Now, the one trade-off that I'd like to highlight, and this is something, again, a consistent theme now in a lot of our videos, is the idea of using the shorter dated expiration cycle options, which the SPY gives you multiple expiration series throughout the week, as opposed to something like the DIA, where you're forced to use, say, a Friday options expiration series. Now, coming back to a chart of the full-size Dow futures, in this first move right here, what you should actually notice using the cyan line, not the beginning of the clouds, is we were looking for a move, I believe, of 76 points. If I take our cyan line right here, we go to the outer edge of the clouds, 78 points. We ended up going close to 76 points before we had a reversal. So technically, this Dow trade right here was a loser for me, despite having all of our signals met. The only way I think it was a winner for those of you who got the cloud entry and you instead had a lower target that you were looking at. So again, Dow more volatile. Now, once we had that stop out right here, that's then our sign to switch over from our scalper to the aggressive volatility box. Once you load in the aggressive volatility box models, if we take a look at that same hour, you'll notice you didn't breach the cyan lines there, and we keep looking for the rest of the day here where the Dow didn't breach anything else. So that first trade in the Dow, while we did see that a little bit of a reversal there, fell just a little bit short of that bare minimum first target, but the S&P in contrast, we had plenty of opportunities there where we had one trade with the long, we had one trade with the short, and you had that final breach as well, giving you winners to help make up for this loss. Now, the final market is the Russell that we'll take a look at in this video. And the Russell, coming back to our scalper volatility box models right here, the Russell should look a little bit more different, very similar to the Dow, in which in that first hour right here, we breached our cyan line. Then we had a pretty nice bounce, right? So we're continuing to use the scalper volatility box models, which are then breached in that 7 to 8 a.m. Pacific hour. Now, once this is breached, we're looking for the edge signal. And in the case of the Russell here, we went outside of the volatility box clouds. If I zoom in here, you can see that a little bit clearer before we got the edge signal. Once we went outside, that was then our sign to switch over to the aggressive volatility box models. Zooming out here, using the Russell, and this is again my conservative approach to trading, where as soon as we break outside of the clouds, that's my sign to switch on over. I know a lot of you will still continue to use the scalper, where using the scalper here, so off of the aggressive you'll see no breaches, but using the scalper here, once you did get the edge signal, you basically had a better, more defined place to put your stop outside of. You still had the opportunity to enter at the cyan line or better, and you can see that that gave you a pretty nice reversal in the Russell, which I think broke our trade plan rules, but still meets, I think, a lot of our members' more aggressive trade plan rules. So keep in mind, you can tweak the trade plan based off of what your style looks like. For me, this is no trade based off of the fact that we went outside of the clouds, and that's where I switch over to the aggressive. But for those of you at least using something like IWM options, where I know a lot of you don't mind building your more aggressive positions, especially for those looking to build just longer term trades as well, like swing trade sort of ideas, that's where you can still essentially use this as a more aggressive scale, where the edge signal is your confirmation with their volatility box levels, and this is more of a context zone in which you're starting to build that position. All right, so that was a chart of the Russell, and now if I just cycle through the bonds real quick as well, because I think the bonds, just to give you an idea of if they had anything interesting here, you'll notice all day long when we're seeing this volatility in the markets, the bonds and their aggressive volatility box models really just doing a whole lot of chopping sideways, no real edge there in terms of breaching either side's cyan entry lines, which for all of our members, you'll notice whenever that happens in conjunction with the volatility with the indice markets, that gives us some clues as well. All right, hope this video helps. Really, the key takeaway there was using the Cumulative Tick Pro indicator, the market pulse, along with the volatility box, all three in tandem there, and then finally the edge signals to try and play the reversal moves, which helps you play not only the moves down into the levels, but also the moves up away from our volatility box levels. All right, hope this video helps. Good luck trading the rest of this week. Keep in mind that our scalper, with the latest update, even as of this weekend, should help to catch some more of these moves compared to what I think we've typically seen the scalper being, which is much more aggressive trades. Here you'll see the scalper's doing a much better job of containing price action now with our latest update. All right, take care. We'll see you in the next update.